Welcome back to this special MPC broadcast. Of course, we learned from the Reserve Bank Governor Lesitsha Kganyago that the Reserve Bank has raised interest rates by 25 basis points, taking the repo rate to 7.25%. I'm joined by two analysts, economists, Arthur Kamp, who's the chief economist at Sanlam Investments, and Johann, he's an economist from Old Mutual. He is the chief economist at Old Mutual, shall I say. Thanks very much, gentlemen, for joining us. The 25 basis point increase, it's not really in line with expectations. More economists had expected 50 basis points. Your thoughts, Johann?
Well, I think it was a prudent decision. We're getting, or are actually seeing peak in inflation, and we're seeing all kinds of indicators that inflation is coming off. But as the governor rightly said, there are still many uncertainties and many risks. And that's the job of a Reserve Bank, to watch out for all of those risks. So I think it's a prudent decision to hike rates firstly, but I also think given the fact that there are lots of growth risks around as well, and inflation is going to fall quite substantially, in my view, during the course of this year, a 50 basis point rate hike would have been too much. So this is in line with my view of a 25 basis point increase. But a prudent decision, given all the risks on both sides in terms of growth, in terms of inflation, in terms of all the uncertainties that's still out there. But I do think that this hike probably, very likely, is the last hike in the cycle. That now the Reserve Bank will pause and over the next couple of meetings do not do anything with interest rates until they're sure, of course. But I think this is the last hike in this cycle. I think the next move, whether it's late this year or sometime next year, will be a cut in interest rates.
Arthur, are you as optimistic?
Hi, Nompu. Yes, I'm optimistic in the sense that we must be at or pretty close to the top of the interest rate hiking cycle. I was very much also hoping for a near 25 basis point increase at this meeting, and the key reason for that is that if you look at where the Reserve Bank has come from, yes, it's come from a very low base, but it did a lot of front loading of interest rate hikes last year. It started early, and so we still need to see the lagged impact of those interest rate hikes from last year coming through. And our work is very much in line with what the bank's quarterly projection model is showing at this stage, which is a repo rate of rounded off 7.1%, just 7.1% end of this year. And so, the fact that they've gone a little bit above that, I think, reflects their concern about inflation expectations that have picked up a little bit. There was a small upward revision to their inflation forecast for next year. But it pretty much looks like we are now looking for the top in the cycle. Whether this is exactly it, our work would suggest that we wouldn't be uncomfortable with that. But of course, you can never tell. The Reserve Bank's MPC is not bound by their quarterly projection model, and they might feel that they need to do a little bit more. But certainly pretty close to the top. I think it was, as Johann said, a prudent decision.
Yeah, I did notice that the governor's speech really focused a lot on load shedding and its impact, not just on the economy and its ability to actually push forward, but also on the cost of doing business in South Africa. The fact that if you don't have electricity, you have to make a plan B to be able to get some electricity and so on and so forth. Him saying that that could actually be a risk in terms of raising costs in the economy, which could then change the view of the inflation trajectory. Johann, your thoughts there?
No, absolutely, that's correct. But I think we are so deep in the electricity crisis at the moment, and I think we're using this crisis to do something about it. We're not just sitting back. Many businesses are doing a lot in terms of self-generation. I think there's lots of projects around that will get electricity online pretty soon. I do think we're going to have lots of load shedding this year, but I do think that we shouldn't be too much focused on upside risks for inflation or downside risks for growth. While they are there, I think we tend to overestimate both the downside growth risks and the upside inflation risks. So there's somewhere in between where we'll turn out to be. The economy, for instance, have become a lot less energy intensive over the last 10 years or so. Whereas 10 years ago, many shops would be closed during load shedding. Now that's not the case. I do expect some kind of impact, both in terms of growth, but also in terms of inflationary impact. But we've moved away from that heavy intensity. So there would be some impacts. Inflation will still fall. It might fall a little bit slower than what I expect if there's lots of price impact. I do not think that looking at the number of load shedding days is a very good measure to measure the impact on the economy, for instance. Businesses are able to run better. So I don't think the impact on growth on the one side or inflation on the other side is or will be as severe as the Reserve Bank might think. I think there's an in-between there somewhere.
But Arthur, when we listen to the governor, his outlook for growth is quite worrying. He says that given what we're seeing with load shedding and the expectation about the amount of load shedding we're going to experience, he expects that the economic growth could be cut by 2 percentage points this year. So now they're estimating that the economy is going to grow by 0.3% in 2023 as opposed to 2.3% because of load shedding. Surely that's quite significant. But of course, it would be a short-term thing because in the interim, as Johann says, people are making investments to get alternative power coming on stream.
Yes, no, it's essentially saying the Reserve Bank is saying the economy is stalled, really. 0.3% is no growth at all. They did revise down from 1.1, so although they're saying subtracts over 2%, they'd probably already factored in before the more recent round of load shedding, which has intensified, and I think that's what caused the bank to go further. It's very difficult to tell exactly what the level of load shedding would be this year. I think the point Johann raised is very important. The economy has become more efficient, uses less electricity, and it's been quite a long-term downward trend in the amount of electricity used per unit of GDP. And it's very difficult to tell to what extent the economy can keep doing that. I assume that it will, out of necessity. And so it's quite hard to pin that growth rate down. I thought an interesting point around electricity and price increases was that the bank is saying, it would be helpful if we got electricity supply up and board, because obviously you fix electricity and also other administered prices in the economy, which are so high. The bank is arguing that that's interfering somewhat with the transmission mechanism. So it basically says monetary policy needs to work harder in this kind of an environment than it ordinarily would need to because of all these impacts. And so you've got the supply shock in electricity, which is causes downward revisions to growth, but also puts upward pressure on prices. And so, we're sitting with a repo rate now of 7.25%, and potentially maybe this is the top, maybe we go to 7.5%, we'll wait and see. Relative to what our work has been showing, which is very similar to what the quarterly projection model is showing, which is sort of, 7, around about 7 the end of this year, end of next. So we're already above what the QPM is showing. And I think the Reserve Bank is emphasizing the point quite correctly, is that it can't do all the heavy lifting on its own. We need to fix these issues, these supply side issues and these infrastructure issues, because it would make everybody's job easier. It would help the economy to grow faster as well.
Let me just focus on food inflation specifically, because that's an area of interest, particularly for our viewers. That has been stubbornly high. The Reserve Bank governor talked about an expectation of moderating spending in this year. What's your view, Johann, may I start with you, around the state of the consumer and how they're going to manage going forward?
Yes, no doubt the consumer are under pressure, severe pressure. Interest rates have come up a lot last year, and so has inflation, of course. But I do think the recent trends that we've seen, headline inflation seems to have peaked and has started coming off. I expect that trend to accelerate during the course of this year. Within that, food inflation was more stubborn over the last couple of months of last year than I expected, but there are increasing signs with international food prices having come off, grain prices having started to come off. I think there might be a little bit more pressure in the pipeline for food prices, but overall I expect food inflation, and that's the year-on-year calculation of food prices to start coming off. So as you know, inflation says virtually nothing about price levels. So even though food prices might remain very high, I doubt whether they're going to rise to the same extent as last year. So food inflation will start to come off. Perhaps not as rapidly as overall headline inflation, but also should decline. So if we bring back that to the consumer, I think with inflation falling quite rapidly, and I expect inflation to come back to the midpoint of the target range, which is 4.5%, far quicker than what the Reserve Bank's estimates are. So I think that lower inflation will be of some benefit to consumers. I know that there's lots of pressure around electricity price increases, etc. But again, lower inflation this year compared to much higher inflation last year. And even though interest rates are high, they just a little bit above what they were pre-COVID. So overall, for consumers, I think maybe this year might turn out to be not as bad as many people fear. Certainly not great, but I still think consumers have got some excess savings. It's not as much as it was last year or in 2021. And there's some employment growth. Not enough, of course, but there is some positive employment growth. So real income growth should actually get some boost this year compared to last year when it was under severe pressure. So consumers, yes, it's tough times. I think for me, the biggest negative around for the economy and for consumers is the impact on confidence through this load shedding issue that's facing us. That impacts on confidence, that impacts on our ability to spend, that impacts on businesses' ability to spend or the willingness to spend. And that's for me the bigger negative apart from just the financial side.
Yeah, Arthur, I just want to pick on something that Johann said about real incomes increasing. Would you agree with that? Because when we saw the take-home pay analysis that's done by the Banks of Africa, they talked about seeing an increase in take-home, but not necessarily, and more as a product of more jobs created. So at a lower level, but not necessarily real nominal increases in people's incomes. What do you think is behind any increases? Is it that there are more jobs or that people are getting more increases at their workplace?
Nompo, I think the recovery in employment, if you dig into the data, a lot of it has been temporary jobs. The more permanent jobs have really lagged in the recovery in job creation. So there's been a significant amount of job creation. I agree that there's going to be positive employment growth this year. I also agree that inflation is going to be lower, and if inflation is lower, then in real terms your real income growth improves. But I do have a concern here. If you take all the data that's available and also looking at the national accounts data, which shows us personal disposable income, unfortunately it comes out with quite a lag. So we've only got the third quarter data, but I think it speaks to the situation that we have on the ground. We actually had quite a sharp jump in personal disposable income in the third quarter, but not the compensation component, so not the component where people are in jobs and earning income. And it most mainly the other forms of income, and a lot of that is sort of dividend income, net interest income, rents, and other forms and obviously include social grants. It's a whole range of things in there, but a lot of that income tends to accrue to higher income earners. So what we have is an economy where the job creation that we're getting is temporary. If you have temporary jobs being created, then maybe your ability to negotiate high pay is not very high. And also where there is been firm income growth, a lot of it's related to sort of non-compensation. And of course, we know that with inflation and food inflation in particular being so high, that inflation rates have been higher for lower income groups. And so I think the lower income groups in this economy are under significant pressure. But on margin, as we go through the year, I'm not saying by any stretch of the imagination that things are going to be great, but there should be some relative improvement. I must add one final point. What I am uncertain of and have not been able to factor in yet is the impact of load shedding on food production and what that would do to food prices. There seems to be quite a constraint in certain areas. It seems to be hitting certain forms of food production quite hard, and we know that when that happens, that prices might tend to go up. But that is an unknown, not factored into forecast yet.
Yeah. And then one last question. I will pose that to you, Johann. The governor spoke about the fiscus being under risk. He talked about, because obviously there's a lower commodity flow in terms of commodity prices have gone down. The taxman is not able to get as much as it did from the mining sector as before. And also the global economy generally is expected to falter somewhat this year. How much of a threat do you expect that to be ahead of us hearing what the finance minister has to say come budget time in February?
Yes, again, it's always good to look at the risks, because then you're not shocked when some of that comes through. But I don't think that Treasury has built into the revenue assumptions for company or mining company taxes significant numbers from tax income from the commodity side. The Treasury has been relatively prudent in those revenue forecasts. So while the governor is correct to highlight some risks around growth issues coming in through taxes into the fiscal numbers, I don't think those are very big probability risks. I think the Chinese economic rebound will take a lot of the pressure away from commodity prices. So there's some underpin, at least, for commodity prices. So the Chinese rebound is also likely to be quite a bit stronger than what most people expected towards the end of last year. So in terms of a global impact on South Africa, it's not as severe. And certainly we're not totally out of the woods regarding our fiscal situation, but the risks have eased quite substantially over the last 3 years. They to some extent still around, and we'll see more in the budget, but especially from the debt side, and translating that into what ratings agencies think of South Africa, I think the rating cycle has really bottomed, because those risks have eased somewhat. And that going forward, of course, the hard work needs to be continued in terms of keeping the fiscal position, the consolidation process in place as strong as it was.
Yeah. All right, gentlemen, thank you very much for your time and your insights there. We were joined by Arthur Kamp, the Chief Economist at Sanlam Investments, and Johann Els, the Chief Economist at Old Mutual. Thank you very much for joining us on this special broadcast of the MPC. And as we did mention to you earlier, the Reserve Bank has raised interest rates, the repo rate, by 25 basis points, taking that to the level of 7.25%. That will become effective from tomorrow. Do check your emails tonight. The banks will be sending you a statement telling you that your interest rates are going to be going up.